Hello again, this is Mike with the NetPicks Inner Circle. In this week's Trade of the Week, we're going to take a look at Twitter. Over the past couple of weeks, we have really seen volatility come to life, really market-wide, but specifically in some of these tech names. A lot of the tech sector has been on an incredible run to the upside over the past few years, really, and we're starting to see some two-way price action kick back in. We've actually seen some pretty big swings back and forth on some of these names. Let's focus in on Twitter here. Let's take a look at the daily chart to start out. Here's what I'm talking about. If you go back into early this year, specifically the last month or so, you can see we've been on a pretty impressive run to the upside. Right? Twitter had a great run from down around the 22 range up to 37, 36.80 to be exact. So we got very, very overbought. Just over the past week and a half or so, we finally saw a pretty significant pullback from the 36.80 level all the way down to right around the 30.50 level. As a result, we're left in a period where we can expect some consolidation from here, market-wide, but specifically on Twitter. After you see the big movement back and forth, the volatility has escalated a little bit. It's not sustainable long term. In the near term, I could definitely see a period of consolidation or even a choppy stretch to kick in. So one way of benefiting from that, we've had some great trades with the long calls, long puts here the last 6 weeks. But now if we're anticipating some slowdown here, instead of just going to the sidelines and not doing anything on Twitter, there are some strategies that we can use to generate some income from that sideways movement. So we're going to take a look at selling an iron condor here today, and all we're going to do is sell an out-of-the-money call spread and an out-of-the-money put spread at the same time. We're trying to box the price in, so we're trying to create a profit window. Instead of anticipating a big move up or down, as long as Twitter stays inside of a range, we can make money. That's what we're looking to take advantage of with the iron condor. So let's go ahead and jump over to the trade page. For this trade, I'm going to take a look at the April monthly options. They have 28 days left to expiration. The reason I like to go out 28 days, by going out 28 days, we start to limit the impact of gamma initially. The gamma basically tells us how quickly the options are going to change for every $1 move in the stock. Right? So the lower the gamma, the better for us, because this trade is going to benefit from time decay adding up. If we go out 28 days, we can just let that time decay add up in our favor without a significant directional risk initially. Can you use this strategy with the weekly options? You can. You just have to understand that you have more directional risk from the moment you put the trade on with the weeklies. All right, so let's go ahead and take a look at the statistics here first. The IV percentile is currently sitting at 48 on Twitter. So what that's telling us is it's right mid-range. Over the last year, taking a look at where the implied volatility has been at, we're right around the mid-range point of where volatility has been over the past year. So what that does for me, anything above the 40th percentile tells me there's enough premium there for me to collect and give myself a good risk to reward scenario. We're starting to stack the odds in our favor when we have the periods of higher volatility. Because we know long term, if you take a look at markets as a whole, when volatility spikes, it's normally not sustainable. Normally going forward, the volatility will start to contract. As some of the fear starts to dissipate a little bit, the volatility is going to contract, and that's going to cause the options to lose value. Anytime that I sell a spread or sell an iron condor like this, I want the options to get as cheap as possible. So whether that be from volatility decreasing or time decay adding up, it does not matter to me. I just want those options to go to zero as quickly as possible. So I'm taking advantage of that higher volatility. When that number is higher, like it is now, what that's telling me is there's more premium in the options. That's going to allow me to collect more premium up front and create a wider profit window. If you sell an iron condor when volatility is low, you can make it work. You just don't have as big of a profit window there to work with. Price action is going to have to stay inside of a tighter range in order to get that trade to work. So with the higher volatility, it's actually a perfect time for us to take advantage of this type of strategy because we can create a little bit wider profit window here initially. So let's go ahead and take a look at the April options. Again, I want to sell an out-of-the-money call spread and an out-of-the-money put spread at the same time. So what I was looking at, I went to the 33.5 call. I right-clicked on that call option. I went to sell, and I selected iron condor. That popped up an iron condor down at the bottom, and all I did is I started to play around with the strike prices here a little bit. I wanted to make sure that we had a dollar-wide difference between the strikes. So you can see there's a dollar-wide difference between the 33.5 and the 34.5 call. There's a dollar-wide difference between the 29 and the 28 put. Because there's a dollar wide difference, I want to collect as close to 50 cents as possible. Our criteria states we want to collect as close to 50% of the width of the strikes as we possibly can. So we're right there. Okay, we're sitting right around 52 cents mid price. Okay, so what I'm doing on this trade, if I click on confirm and send, let's break this down a little bit. I am selling the 33.5 call. I'm buying the 34.5 call to make sure I'm in a risk-defined trade on the upside. I'm selling the 29 put and I'm buying the 28 put at the same time. That creates a risk-defined trade on the downside. Now, my break-even points, I'm going to have two of them because we're selling two different spreads here. My break-even point is going to be 34.03 on the upside. That's if we collect 53 cents to put this trade on. Okay, and actually, let's go ahead and switch this back to 52 cents. So our first break-even point at 34.02, that's taking our short call strike, 33.5. We're adding on the 52 cents that we're collecting to put the trade on. So it puts our break-even point at 34.02. On the downside, we're going to take our short put strike at 29 and we're going to subtract the 52 cents. So that puts my break-even point on the downside at 28.48. Those two numbers define my profit window. As long as price action stays inside of those two numbers, I'm okay. So it's not something I have to sit here and watch very closely on a daily basis. As long as price action is inside of that range, I don't care. If it moves dead sideways, if it moves back and forth, it does not matter to me as long as we stay inside of those two break-even points. Now, the 52 cents that we collect, that's the most I can make on the trade. That's $52 of profit potential for every iron condor that you sell, which $52 doesn't seem like a big number. But when you take a look at how much capital it's tying up, we're only using $48 of capital to put this trade on one time. You can put this trade on 10 times and have less than $500 of risk. So when you start to do the math here, right, if we have $520 of profit potential, if we put this trade on 10 times, that's not a bad return for the next 28 days because remember, our outlook for Twitter is that it's going to get choppy here. If I was expecting a big directional move, there's going to be far better strategies to use. A long call, long put, or a long vertical spread would give us more profit potential. But I'm not expecting a big move. I'm expecting Twitter to stay sideways. So this is one way for me to generate a little income without needing that big directional move. That's why I love to use these types of trades. They're very flexible. They start to add in some different layers of diversification that many of you are probably not used to using. It's a big part of what I do on a regular basis. So now what do I want to have happen here over the next 28 days? Again, I don't care if the stock moves up, down, or sideways. As long as it stays inside of those two break-even points, I'm okay. I make money from time decay adding up and from volatility decreasing. So we have 5 potential ways of making money on this trade. My initial target zone is between 50 and 75% of whatever I collect to put this trade on. Okay, so if I can come in and buy this trade back for between 13 and 26 cents, that would be a good initial target zone. That would give me a really nice profit here over the next couple of weeks. Now, if this trade starts to make a big move against us, if it starts to move higher or lower in a big way, we'll certainly address how to manage that trade going forward as well if it goes against us. Okay, we can start to make adjustments to that trade as needed, and we'll walk through that over the next couple of weeks here on the blog. So make sure you check back if you have any questions on how to manage the trade. We'll keep you posted here in the blog. You can also feel free to email us directly. My email is mike@netpicks.com. Be happy to walk through any details there on this Twitter trade. So again, we're looking to sell an iron condor in the April monthly options with 28 days left. And we'll see if we can get filled on this one today, and then we'll start tracking it here over the next couple of weeks. All right, so I'm going to wrap this video up here. Again, feel free to post any questions here inside of the blog, and we'll be back with you right away. So I'll be back next week with our next video update. We'll talk to you then.